Welcome to Market Monday from the investment team and the trust department at the First National Bank. Let's start with the economy. I mean, we typically start with the economy, but this is particularly salient right now after the fireworks display in Jackson Hole on Friday, where Chairman Powell came out from the Fed and gave a quote-unquote dovish interpretation of the current macroeconomic environment in the United States. So let's unpack what that means. Dovish is typically applied to language and attitudes at the Fed that suggest a view toward easing monetary policy. In other words, making the price of money cheaper. Taken a little bit further, we call that the cutting of the interest rate, the overnight rate. And that's ultimately what it boils down to and what you see in the news. And that lowers the cost of money. When you think about interest rates as being the price of money, you know, you pay this interest rate to borrow it. That's a charge in effect. And that stimulates the economy. That stimulates investment because capital is cheaper to get a hold of, and therefore even lower payoff projects can be taken by corporations because they're going to make a good margin on the money that they're borrowing from projected profits and probabilities associated with them. But in any case, that aside, we're really not seeing conclusive evidence that the conditions are right for rate cuts. So it's a pretty cloudy environment, and with the Fed coming out with dovish language and the labor market shows some weakening relatively to the recent year, I suppose, but is it enough? Is it showing any contraction? Not particularly. It's still relatively strong by long-term historical standards, and prices, in terms of inflation, are up. So if inflation is running at somewhere around 2.6 to 2.8%, which recent reports suggest, we're dubious about the validity of a strategy to start lowering rates and become easy on monetary policy at this time. Interest rate futures markets indicated a large increase in the probability of a rate cut in September. We're not sure that's actually a correct move, but we'll wait and see. We're not in charge of the reins of the economy. We have to react to it, though, as investors. So coming forth over the next couple of weeks, we do have some more fireworks on display. We're going to get information about the real estate market, which is expected to kind of hang out in line with where it's been. Here's the big one, durable goods orders. That's a demand figure. And it measures the health of demand in the economy, because when consumers are putting in purchases for long-term items, things that they might have to buy on credit, durable, long-lasting goods, they're less likely to make those investments if they think economic conditions are deteriorating, and more likely to if they think things are improving. So when we look at, the prior reading of negative 9.4%, and it's expected to shrink by only 4%, that actually suggests that economists think that the demand situation might be getting even a little bit stronger than it's been recently, which is another inflationary type reading, even though it's still negative. We're going to get information about manufacturing, and consumer confidence is a huge one. That consumer spending is about 2/3 of GDP growth, gross domestic product, or economic growth in the United States. So if consumer confidence is at a good level, which 96.4 the expectation is, and 97.2 the prior reading is, those are relatively decent readings. That shows that consumer demand is likely to remain pretty constant. If consumers are confident, they're going to keep spending the same way. We're going to get the GDP number, which is expected to be revised up for second quarter growth by 0.1%, and that's pretty strong already at 3%. That is not consistent with a contracting economy, quite the opposite. That's robust growth. A developed economy like the United States has a long-term growth rate of about 2%, at least as is commonly accepted by most economists and most economics professors and most economics textbooks that have ever been written. So this 3% is relatively robust demand and relatively robust growth, and it suggests that maybe it's not time to cut rates. Personal consumption index, we're going to be getting price index, we're going to be getting the core PCE, which is the Fed's favored reading on prices, 2.5%. So that's interesting. We get more information, income and spending, both of which are expected to show an increase from last month. Again, that's an inflationary figure. The PCE, the core, growing on a month-by-month basis of 0.3% or a year-over-year basis of 2.9. That's going to be increasing, and this is the actual one that the Fed's looking at. So we're running at about a 3% inflation, and yet the job owning is about rate cuts, which is inconsistent with decades of Fed policymaking. So, it remains to be seen what happens, but again, this environment's really unclear. We're not seeing signs of decelerating economy, and we're seeing signs of inflationary pressure. What's going to happen, we're not really sure. But we get sentiment indicators, all of these, ISM manufacturing, how manufacturers see the world, University of Michigan sentiment, how, demand is being looked at, factory orders, and so forth. More labor market information will round everything out, and, on the 5th, we get the change in the non-farm payrolls. This is generally a big firework number, and here's where we're starting to see, some concern. We haven't seen actual contraction in job creation, but we have seen a deceleration that's pretty substantial from a level that was over 200,000 for most of the past recent horizon, and that's expected to show a relatively anemic 85,000, and that is one of the indicators that the Fed's going to use, and it's also the one that is consistent, in our opinion, with the policy of potentially lowering rates, particularly if they're more concerned with health in the labor market than they are with inflation, which does appear to be the case. But let's talk about what could potentially happen if the Fed lowers rates while there is inflation. We had a period in the 1970s that's called stagflation, where you had declining economic growth at the same time you had high and rising prices, aka inflation. And that was a particularly miserable time in economic history. People are getting laid off, jobs are scarce, and it's tough to find ways to keep up for consumers at the same time that everything is going up in cost. That's not a recipe for a very pleasant environment in the country, in the communities. So why am I talking about this now? Well, if in fact we lower rates in September, when it's not needed. Think about when people are all taking antibiotics and it's not needed, and now we have these, bug-resistant strains of bacteria where the normal medicines don't work. They're setting the economy up for that type of situation, that type of drug resistance, so to speak, to the antibiotic of interest rate price changes. So potentially when the economy eventually does decelerate, and this thing is a cycle, the Fed doesn't control the economy, it steers it. And when inevitably the economy begins to shrink, if interest rates are low already and inflation is high, the prices are going up and up and up, when they try to go in and lower rates even further, the inflation is likely to be magnified. It's like throwing another couple logs on the fire, and then prices go up by even more, and that's a bad circle to be in, because as prices are going up, more and more consumers are unable to afford things, demand slows down, and the economy further decelerates instead of getting, stimulated. So we're a little bit worried about the longer term future of everything if they really begin to lower interest rates. But, then again, we have to take on faith that the Fed knows what they're doing. They've got trained economists, and, we'll wait and see what happens. Implications for markets, going forward. Let's look. The S&P really loved that commentary on Friday, going up from there to there about, 504. Yeah, that looks like about more than 150 points, about 100 points. And, that's a relatively reasonable gain for a day based on just a news report on sentiment. Does it really mean anything? Well, we're not sure, and we are trading up very near all-time highs in the S&P. We're also trading well into all-time highs at the MSCI EAFE, which indicates what's going on the global scale without regard to the United States. And we're pointing this out because, that index for decades has been, or at least a decade, has been relatively anemic in growth relative to the S&P, which measures U.S. domestic stocks. And now it appears that opportunities are, in fact, increasing on the international stage as well, in part from geopolitical and monetary policy differences among the different countries. So this is actually pretty robust chart for the global markets, and we do have an increased exposure and thoughts on increasing exposure in the developed economies. Europe, developed economies in Asia, not talking about China, which is considered an emerging market, but the developed nations probably represent a decent opportunity set and deserve to be looked at a little bit more. Volatility has come down dramatically, and over the long term, well, we'll get back to that at the end. We always like to close with that screen. And let's go in and look at what's happened in the treasury markets. Since the beginning of the year, rates are down pretty sharply on the short end of the curve. And for most of the year, we're looking back a little bit. A month ago, rates were a little bit higher on the 10-year. The thing is, out over the longer term, inflation is the primary driver of treasury yields. So when we see the long end of the curve getting up there, we see longer term expectations of inflation, which is the only pricing component of treasuries really. Those expectations have to be growing mathematically the way that treasuries are priced. And it's interesting to note that we actually see higher short-term interest rates than we did at the beginning of the year and at, just a month ago. And why would that be when the Fed's talking about lowering rates? Well, the Fed doesn't exactly have the power to control the rates. They set a band within which rates can float, but ultimately rates are set by an auction process between market participants. And, even though the short-term overnight cash money rate might be going down, the rate to hold treasuries is going to be consistent with expectations of what a real rate is. This suggests to me that the market thinks the Fed is potentially going to keep rates artificially lower than they should be. But that's just an opinion, and I wouldn't put too much weight into it. This is a highly complex area. Going into the corporate yield curve, where we do have other things besides inflation expectations to think about, this curve has behaved similarly. It's coming down on the short end, but it's going up pretty sharply on the top end, and that reflects a few things. The corporate bonds are priced in terms of yield by both inflation expectations, just like the Treasury, and expectations that there is some probability that any given corporation goes into default over a horizon. And when we look at this curve, what this is telling us, this story, is that, as we go out there in the short term, conditions are going to be easier. Corporations are going to be able to borrow more cheaply and probably be more profitable, and then there's less likelihood of default. But over time, the price of things, input costs, is probably going to continue rising, and that is going to in turn be harmful to some companies. When the price of money and the price of goods and input costs gets higher, it becomes much more difficult for corporations to compete, and the weaker ones are going to be weeded out. And that is what is priced in here as you see yields rising over the longer term, a much more competitive environment. What does that mean for you? Really not a heck of a lot. If we look at the long-term implications of growth or contraction in the economy, if we look at the longer-term cycles of the market, overwhelmingly the idea is get a good investment strategy in place that meets your goals and then stick to it. And don't worry about when times get woolly. 2008, we thought the world was ending. 2020, we thought the world was ending. Back in 2022, wow, we're in a really bad bear market. Earlier or toward last year, earlier this year, we had an extreme drawdown, and we thought we were in trouble, but we weren't. And so the trick is we don't want to panic and be selling down here because we're afraid, and we don't want to necessarily be buying willy-nilly up here with the idea that hey, everything is great and it's going to go on forever. We don't do either of those things. We stick to a disciplined approach. Hopefully you found this video useful, and if you want to, talk to us about this, we love to do that. Feel free to reach out. Thanks. Have a great day.